Welcome to Stock Option Traders. Damn, son, where'd you find this?
What's up, YouTube? Stock Option Traders here, coming to you with the first video in our new series on how to swing trade covered calls. In this video, we're going to go over what covered calls are, how they work, and how to use them in your swing trading strategy. First, let's define what a covered call is. A covered call is simply an option strategy in which you hold a long share position and sell call options on that same stock in an attempt to generate income from the option premiums. Me personally, I like to sell covered calls and cash secured puts on stocks like Tesla, Apple, Nvidia, and Google because the premiums are always higher due to increased stock volatility. Plus, at the end of the day, I don't mind holding these shares long term. For smaller accounts, you can also trade covered calls on stocks like Affirm, TQQQ, and EXPI. Now, let's talk about how covered calls work. When you sell a call option, you're essentially agreeing to sell the underlying shares at a predetermined strike price of your choosing on or before a certain date, which is the expiration date of the option. The person buying the option is hoping that the price of the underlying will increase so that they can buy it from you at the lower strike price and then sell the option for a profit. As the seller of the call option, you are collecting the premium, which is the price of the option itself. This could be a good way to generate income on your long position, as you are essentially getting paid to potentially sell your asset at a later date. However, you need to be aware that if the price of the asset goes above the strike price, you will be obligated to sell it at the strike price. This is known as being called away. Now, let's talk about how to use covered calls in your swing trading strategy. Swing trading involves taking positions that last anywhere from a few days to a few weeks. With covered calls, you can use this strategy by holding on to your long position for a few days or weeks and selling call options with a shorter expiration date. What this allows you to do is collect the premium from the option while still holding on to your long position. To implement this strategy, you will first need to identify a stock or ETF that you believe has an increased IV or implied volatility. The reason for this is we all know to buy low and sell high, right? Well, when you sell to open an option, you want to sell when the volatility is high and buy to close when the volatility drops. Next, you will need to decide on a strike price and expiration date for the call options that you're going to sell. Keep in mind, you don't want to choose a strike that is too low, as this will increase the likelihood of the option being exercised. I personally like to look at options with a delta of about 0.3. Another suggestion is to look at probability in the money, or ITM. Once you've chosen your strike price and expiration date, you can then sell the call options and collect the premium. If the price of the underlying goes above the strike price, you will be called away and be forced to sell your shares at that strike price. If the price does not go above the strike price that you chose, you will still collect the premium, but from there, you can continue to hold your long position and sell another covered call. That's it for this tutorial on how to swing trade covered calls. We hope you found it helpful. Remember to always do your own research and consult with a financial advisor before making any investment decisions. Thanks for watching. If you enjoyed this video, then don't forget to like, comment, and subscribe to the channel, and check out our Discord, link down below.